Do you know that you can build a well-diversified low-cost portfolio with passive investments? Hi friends, do you want to get returns similar to the stock market? Are you looking at a buy and hold investment strategy to achieve your long-term financial goals? Well, if you want returns that match those of the stock market, you must watch this video. After all, as Warren Buffett says, by periodically investing in an index fund, the know-nothing investor can actually outperform most investment professionals. Hello and welcome. I am Simran from Clear and we are India's largest tax and financial services platform. At Clear, we serve 400,000 plus growing businesses and 2,000 plus large enterprises. We have assisted 80,000 plus tax experts and 6 million plus tax filers so far. And in today's video, I will tell you what passive investing is and why it can be the best strategy for novice investors in the equity market. Subscribe to our channel and hit the bell icon to get notifications on our latest videos. Passive investing is a long-term investment strategy that involves tracking and replicating the portfolio of a market index such as the BSE Sensex or the Nifty 50. It helps you get returns that match the market index rather than looking to outperform the index. The two most popular passive investing options in India are index funds and exchange traded funds or the ETFs. Passive investing is the opposite of active investing. Fund managers of passive funds try to own all the stocks in a given market index in the proportion they are held in that index. The most popular way to try passive investing is by taking a passive fund such as index funds and exchange traded funds or the ETFs. Passive funds track and replicate the portfolio of an Indian or foreign market index, and second, passive funds track the domestic price of physical gold. Now let's take a look at some popular passive funds. A market index such as Sensex or Nifty is made up of stocks. These stocks are held in different proportions in the index. Now, an index fund is a mutual fund that mirrors the components of a market index and offers returns that match the index it tracks. ETFs are similar to mutual funds in structure and regulation. ETFs track a market index such as the Nifty 50 or the Sensex, a commodity or a sector. Now, what makes an ETF unique from mutual fund is that its units can be bought and sold on the stock exchange. The net asset value or the NAV of the ETF changes depending on the stock market movements. You may have heard of the Gold Exchange Traded Fund or Gold ETF. It is an ETF that tracks the domestic price of physical gold. Now let's take a look at some salient features of Gold ETFs. First, Gold ETFs represent physical gold in paper or dematerialized form. Second, one Gold ETF unit equals 1 gram of gold. Third, Gold ETFs are backed by physical gold of the highest purity. And fourth, gold ETFs are listed on the stock exchange and can be bought and sold like stocks. You need to open a demat and trading account with a broker to conveniently invest in gold ETFs. When you redeem gold ETFs, you don't get physical gold but receive cash equivalent to that gold. You can invest in foreign stocks too through passive funds. You have to invest in international funds. Indian AMCs offer an opportunity to invest in international funds whose portfolio mirrors a foreign market index such as the S&P 500 or the Nasdaq 100. I hope by now you might have understood how passive funds work. Don't you think you should invest in a passive funds to achieve your financial goals if it matches your risk tolerance? If yes, then please type yes in the comment section below. Indian mutual fund investors historically prefer active investing, where the fund manager actively manages the portfolio. However, passive investing is catching up quickly, especially after the COVID-19 pandemic. The total assets under management or AUM for index funds increased from around 8,082 crore in January 2020 to 22,904 crore in May 2021. It is a lump in growth of 183%. The total assets under management or AUM for exchange traded funds or ETFs including gold ETFs increased from rupees 1,84,534 crore to 3,16,289 crore. It is a jump in growth of 71%. These numbers show you that individual investors are adding index funds and exchange traded funds to their portfolios. You could now focus on a blend of passive funds and active funds to build an all-weather portfolio. Let's look at some prominent passive funds that can be a part of your passive portfolio. Experts recommend that you build a core portfolio for stability and to achieve your long-term financial goals. Core portfolio consists of 65 to 70% of your portfolio, and you could include index funds and ETFs in this portfolio. Financial advisors advise allocating 5% to 10% of your portfolio towards gold. You could invest in gold ETFs for the requisite allocation. Experts recommend having a 10% allocation of your portfolio towards international funds to diversify your investment beyond the Indian stock market. You could invest in international funds that track the S&P 500 or the Nasdaq 100. Passive investments are hassle-free and help tap the growth potential of the stock market. First-time investors can invest in the stock market through passive funds. It has lower fees than the actively managed funds, as the fund manager doesn't have a major role. Passive funds can generate inflation-beating returns over time, and the portfolio is automatically rebalanced by removing non-performing stocks. Understanding tracking error. It is the difference between the returns of the index fund or ETF and the benchmark index. The tracking error shows how closely the index fund or ETF replicates the return of its benchmark. You must pick an index fund or ETF with a low tracking error to get returns that match the benchmark index. Tracking error is caused by the mutual fund expenses and by improper replication of the index. Check the expense ratio. You must opt for an index fund or ETF with a lower expense ratio to increase your take-home returns over time. The expense ratio is the cost of managing the mutual fund. Investors in India prefer actively managed equity funds as they have the ability to generate returns above their benchmark index. However, many actively managed equity funds have underperformed their benchmarks recently, thereby failing to justify the higher charges involved in managing these funds. Many investors are now looking at passive funds that offer returns in line with the stock market and also have a lower expense ratio as compared to actively managed funds. Received some valuable information through this video? Then please hit like and share this video with your friends who may find it useful. Do not forget to subscribe to our channel so you can get access to more tax related videos. Till then, take care and goodbye. This is Simran signing off.